And I think you have to kind of take a step back and see what the biggest players in the world are doing. And the biggest players are the central banks who are massively de-dollarizing and buying commodities. And I think that's kind of the thrust that fits hand in glove with Zoltan Pozsar said. We are heading into a new era based on commodities and transparency, not opaque debt instruments and promises that seem to fall short. And I just think that this is something that will be a very, very.
You're watching Silver News Daily. Like this video and subscribe to the channel for the best news that you don't want to miss. Now let's get straight to it.
Imagine this, a world where the shimmering allure of gold is outshone by its often overlooked counterpart, silver. That's right, you heard it correctly. Experts from around the globe are pointing towards a future where silver, not gold, takes the center stage in the precious metal spotlight, soaring to an astonishing $2,080. As we embark on this journey through the labyrinth of financial markets, industrial demands, and geopolitical chessboards, keep in mind, this isn't just another market anomaly. It's a potential revolution in the world of precious metals, one that could redefine wealth and investment strategies for generations to come. In the midst of a landscape dominated by the glitter of gold, silver has been silently weaving its own narrative. A narrative of resilience, potential, and untapped value that's just waiting to disrupt the status quo. So, as we delve into the intricacies of this unfolding saga, ask yourself, are we on the brink of witnessing silver's meteoric rise to prominence? The answer lies ahead, and as we unravel the tapestry of economic trends, historical data, and expert insights, remember, this journey is more than just numbers and charts. It's about understanding the pulse of the market, the whispers of the past, and the predictions of those who dare to look beyond the horizon. Stay tuned, subscribe to our channel for this riveting exploration, and remember, this isn't just investment advice. It's a ticket to understanding how, in a world brimming with uncertainties and opportunities, silver is setting the stage for a spectacle that could redefine the precious metals market. Join us as we uncover the story of silver's potential ascent to $2,080,
right now, if you ask me, for
long
the
before
next
gold
day
even gets a
so,
chance
I
to catch
see
up.
Silver coming off, and even for the next week, 2 weeks. But I'm expecting you asking me, Francis, if I speak to you in 6 months or a year's time, where's silver going to be? And for me, that then becomes a lot more interesting. And the main driver, it's kind of the truck and trailer, and I call it, you need to visualize the relationship of both gold and silver as a kind of where gold is the truck and silver is the trailer. And instead of a traditional tow bar between them, there's a bungee cord. And what tends to happen is you start to hit a big hill, and the 4x4 or the truck floors it and starts to pull quite strongly, and the cord starts to extend. The bungee cord that you strangely using as a tow rope actually is the gold silver ratio, and what you see is that extends, and the heavy trailer of silver starts to fall really far behind, hardly moving at all, while the 4x4 is going up. Now, when I'm using this analogy, that in actual fact there's potential energy then being built up in the super thick, it must be said, bungee cord, and eventually you get a catch up, such to the point that the trailer can come whizzing past the truck itself. So I like simple metaphors to help people get along. Now, the answer to that many people say is, oh, Francis, we're sick and tired of hearing one of these days silver's going to happen. You mentioned it yourself, you get fatigue. I just want to point out the first time we ever called a turn in the debt markets and said the debt markets will not be the perpetual bull markets, the buy the damn dip. This is a 40-year cycle, was during the year of 2020. And since then, yields have gone up, even though there's been pullback periods. You're in one of those now, by the way. It's probably worth us later having a short thread on that. But nonetheless, it takes a long time for macro trends to end. But when they turn, they turn and they turn and they stay turned, and they then move for a very extended period. And in actual fact, they play catch up in the opposite direction. In short, I brought in the debt markets to explain your question on silver, which I've tied also to the question of gold. So I'm adding a lot of variables in here, but I'm doing this intentionally because we've had a 40-year bull market with dips and rallies in debt. That's an escalator. It's a very flat lengthy escalator. Watch the hand, it's kind of like that. You do not get a 40-year mild decline like that from that escalator height. You take the elevator down. It's the end of a debt system. There's not a symmetrical corresponding unwinding event. It is far more abrupt, harsh, and rude, and it's really fast. But for that setup to occur, it takes a bit of time. Essentially, we're waiting for an elevator cord to snap for the debt market. Now, why talk about the debt market when the question's about silver and gold? Because they are the two competing money systems. So one involves a banking system, which is an intermediating. You borrow money into existence. You have a T-bill account, an asset and a liability. You take out a mortgage, you own a property, but actually the bank owns it. That becomes, you are their asset inherently. That is the current financial system, which is in the process of breaking. Now, the turbo juice, as I like to say, for both gold and particularly that lagging with real tension in the bungee cord rope silver, really comes to life in the capitulation and failure of the other alternative. When both, we kind of have a parallel system. You do have both as money systems. It's just gold and silver is not effectively being used as one materially at any great level. Gold is starting to be used again as store of value rather than debt. So that process has already begun. But in terms of daily transaction money, silver doesn't have a role yet. It's just an industrial metal that's supposedly a bullion. So what happens is as the debt collapse occurs, and in this question, I'm tying other markets to it. And I want to point out to everybody, March 2020, peak bond valuations. The rates, the yields dripped right down to 0.3 on the US 10-year debt markets. That was the point that the gold-silver ratio simultaneously. So for those that doubt that these two things are tied at the hip, the success of one is the failure of the other, and the failure of the other is the success of one. Just go look at the technical charts. The 128 gold-silver ratio occurred as you had peak bonds. 0.3, buy the damn dip. Everybody from a lot of the stars that we follow on Twitter with massive followings, buy the dip on bonds, wear diamonds. That's what they're saying. We came out and said, buy the dip on bonds, wear coal. And in fact, that's a slur on coal. Coal has actually got great use as an energy use case and will probably hold its value far better, apart from not looking particularly fashionable if you're wearing it around your neck. So in terms of all of those things, silver's fate is tied to gold, even though there's this divergence. It's a very thick bungee cord. It can stretch real far, but the notion that the relationship will be entirely severed is wrong. So everybody who's sitting here and saying, damn, silver looks soft, like it's going to go lower. It's at about 23.5, and it's drifting off. You could drop again to the low 20s. That's primarily because gold is also looking a little bit toppy. Should we refer to the charts to take on that technical side, Jesse, and let you unpack some of that in the meantime?
As we delve deeper into this unfolding narrative, it's crucial to understand the forces at play within the silver market. Currently, we're witnessing a scenario that's as intriguing as it is complex. The price of silver, influenced by a multitude of factors, seems to be painting a picture that not everyone is seeing clearly. It's a picture characterized by short-term bearish trends, yet, beneath this seemingly gloomy surface, there lies a story of potential and anticipation. At the heart of this narrative is the role of the Federal Reserve, whose cautious strategy on rate cuts is reshaping the investment landscape. This isn't just about reducing the appeal of non-yielding assets like silver. It's a chess game of economic policy, where every move has far-reaching implications. As investors are enticed towards yield-bearing assets, silver's charm dims in the immediate glare of rising treasury yields and a robust dollar. But here's where the plot thickens. The current state of the silver market isn't just a reflection of monetary policies or currency strengths. It's also a barometer of global economic sentiments. As the dollar reaches peak strength, making silver more expensive for international buyers, we see a decline in global demand. This interplay of currency dynamics and investment choices is painting a bearish outlook for silver in the near term. Yet, for the astute observer, this is not an end, but a prelude. The question we must ask ourselves is, are these short-term trends merely the shadows before the dawn of silver's rise? Is the current bearish sentiment a veil that, once lifted, reveals a silver market brimming with potential? Remember, the journey of precious metals in the financial markets is rarely a straight line. It's a path laden with twists, turns, and the occasional backtrack. As we navigate through this labyrinth, it's essential to keep a keen eye on the undercurrents. The short-term decline in silver prices, while influenced by the hawkish stance of the Federal Reserve, rising yields, and a stronger dollar, is not the whole story. There lies a deeper narrative, one that speaks of resilience and potential, waiting to unfold as we move forward. In our next step, we will venture further into the past, exploring the historical context of the gold-silver ratio and how it has shaped the journey of these precious metals through the centuries. Stay tuned, and remember to subscribe to our channel for this insightful journey into the heart of the silver market.
Yes, so again, as I mentioned, if we go to US oil, which is WTI typically, I do feel this is what happened March 2020. Now, there was very specifically an end to movement, but I do feel that you can't rule out such a thing happening again. And this chart is not looking nearly as good as the uranium chart. On the uranium chart you had two highs, and the second high was almost as high, and you're holding a blue line at 28.50. If you look here in the oil chart, you can see exactly what this is telling you. This pulled all the way back. We called this top on a bit of technical analysis here, and it's come right the way down. And this rally is not nearly as strong, and this is pretty flat. And can I also point out, OPEC Plus, which includes Russia, has twice done production cuts. So the notion that this economy is everything is awesome. I prefer the image of the dog drinking his coffee and everything's burning on fire, if you know the difference. And he's saying everything is awesome. This is not on two production cuts a good, and that's again, statist involvement. They're matching the amount of production and they are cooperating so that they don't both force a glut as we had over here when they weren't cooperating and everybody wanted a minimum amount of revenue, and as the oil price dropped, pumped more oil to make their number, and you got an absolute glut at a time where everybody stopped driving, stopped flying, and stopped doing everything. Well, that's a great way to screw your market up, as you then saw, and I think we went from a few hundred offshore drills to about 3 or 4. And most of them hit the wall. So this is not technically strong compared to the uranium, and I'm hoping guys will appreciate that. And I could see on a further weakness in the economy us trading below that level. So what is that level that you kind of a floor on at the moment? Let me just grab the price chart. Roughly around the 70s level. I could see us slipping through the 70s into the low 60s and possibly the 50s. So I'm not short or even medium term on account of the consumer and demand destructive events, which we are already in with the super high inflation, which is higher than the BLS numbers are telling you, the state of the debt collapse, and the potential for more downside event risk. Let's just leave it there. So that is not a good setup for oil. As not a good setup for oil. We already have all the wars. We've got an Israel war that's likely to expand into Lebanon chasing Hezbollah. We have Ukraine, Russia that can always escalate. None of that's done anything for the oil price. We've had 2 production cuts. That tells you consumer wrecked. Not flying, not driving, and it's also in packaging, it's in deliveries, it's in everything. So oil is much less interesting. Longer term, if you talk in 10 years, if the system is, and we could still price it in current dollars, assuming that currency still exists, I would expect it to be higher, but not the...
Venturing deeper into our exploration, we now turn the pages back to delve into the historical annals of the gold-silver ratio. This ratio isn't just a number, it's a silent storyteller, whispering tales of economic epochs, market sentiments, and the intrinsic value placed on these precious metals through centuries of human civilization. Rewind to a time when the gold-silver ratio stood steadfast around 15:1, a period stretching from the late 17th century well into the 1800s. This era saw the two metals move almost in harmony, with silver enjoying a prominence and value reflective of its utility and acceptance. But then the winds of change began to blow. The 1900s marked a seismic shift. Gold began its ascent, soaring to heights that left silver a mere spectator in the shadows. The gold-silver ratio started its erratic dance, fluctuating between 18 and 100, a clear testament to the growing chasm between the values of these two metals. Fast forward to the recent past, and we encounter a world gripped by uncertainty and change. The onset of the pandemic heralded a modern-day rush towards the safety and stability of precious metals. Investors, driven by fear and speculation, turned their gaze towards these age-old stores of value, causing unprecedented volatility in the gold-silver ratio. In the year 2022 alone, the ratio spiked dramatically from 65 to 95, a vivid illustration of the tumultuous times. But what does this historical perspective mean for our silver story? It's a narrative of volatility, yes, but also one of untapped potential. The history of the gold-silver ratio isn't just about numbers. It's about the underlying factors that drive these numbers. It's about understanding that silver's journey, while overshadowed by gold's glitter, isn't one to be underestimated. As we stand today, pondering over the future of silver and its potential ascent to the unprecedented price of $2,080, it's essential to recognize that this journey is rooted in a complex interplay of market dynamics, historical trends, and human psychology. The historical context of the gold-silver ratio provides a backdrop against which the current market sentiment must be analyzed. It's a reminder that the world of precious metals is one of constant ebb and flow, of peaks and troughs, and of unending cycles of speculation and investment. In our next step, we will shift our focus to the contemporary drivers of silver's price, particularly the intriguing dance between industrial demand and the silver deficit. Stay with us, and don't forget to subscribe to our channel as we continue to unravel the intricate tapestry of the silver market, piece by piece.
So we are going through the 5 stages of a breakout, which isn't into a straight line up stage. That is what we call the melt up stage, and that's normally stage 3 for us. So you're going through the break and feigns, then you go through the second chance, and then you go through the melt up, or if you're on a downside like debt markets, the capitulation. But believe you me, those aren't going to be nice times. There's going to be crazy geopolitics. There's going to be lots of misinformation and deception. There's going to be money lost in banks. A lot of things are going to be going wrong. Of course, if you overweight in the precious metals, you can be happy. But first, gold. And gold hasn't gone into its melt up stage yet. And when it does, that's probably when silver will start to too. But you might see a final little stretch in the cord where it's at its absolute breaking point and it manages to go a little more. And then suddenly, wow, it's almost like that bungee cord is turned into a pole. And any further upside from gold is just going to yank the trailer up, and all that potential energy is going to go. So that's the framing. Match the time frame. If you haven't got multi-year time frame, even decade time frame for this move, we're talking about a systemic global collapse, something they don't want to have happen. All the forces are holding back. So the weight in that trailer is just on that hill, just making it hang and barely roll up the hill at all. Everything is working against it until it loses. So it's like a dam wall bursting. It's going to keep resisting. The water pressure keeps getting more, keeps getting more. That's part of your upside, because when it bursts, the higher that water line is to the dam wall, the bigger the flood downstream. And that's what we're playing for, the power. And the longer the resistance, the greater the surge and the eventual move. So there's a proportionality to everything, and it's a big time frame trade.
As we continue our journey through the labyrinth of silver's potential ascent, we arrive at a critical juncture, the intricate interplay between industrial demand and the silver deficit. This relationship isn't just a measure of supply and demand, it's a testament to silver's dual identity as both a beacon of monetary value and a linchpin in the realm of industrial applications. Silver's role extends far beyond the confines of investment portfolios. Its conductive properties have rendered it a cornerstone in myriad industrial products. From the tech boom that sparked a surge in consumer electronics to the advent of 5G infrastructure, from the burgeoning realm of solar panels championing the green economy to the steadfast demand in investment forms like coins and bars, silver's versatility is unmatched. The year 2021 was particularly telling, witnessing a consumption leap by 9% to a staggering 508 million ounces, signaling an insatiable industrial appetite for this precious metal. However, this surge in demand unfolds against a backdrop of constrained supply, painting a picture of a market teetering on the edge of a deficit. The pandemic's grip forced several mines to slow or cease operations, thrusting the silver market into its first supply shortfall since 2015. Although mines have gradually resumed their pre-COVID output, the chasm between supply and demand remains a poignant narrative in the ongoing saga of silver. But what does this mean for our story? This tension between burgeoning demand and a looming deficit lays the groundwork for a potential price revolution. It's a reminder that silver's allure extends beyond its glimmer, deeply entrenched in the very fabric of modern industry. As the global economy steers towards recovery and green initiatives gain momentum, the demand for silver is poised to climb even further, straining against the shackles of limited supply. As we stand at this crossroads, peering into the future, it's crucial to recognize that the current market trends are but a prelude to what may lie ahead. The industrial demand for silver, juxtaposed against the backdrop of a supply deficit, sets the stage for a dramatic shift, a potential recalibration of silver's value that could see it soar to unprecedented heights. In the next chapter of our exploration, we will delve into the realm of price volatility and speculation, unraveling how silver's swift and often unpredictable price movements contribute to its mystique and potential as an investment. Stay with us and remember to subscribe to our channel as we continue to navigate the complex yet captivating world of silver and its journey towards a possible $2,080 pinnacle.
We'll get those comments. I get them too whenever I do anything bullish about gold or silver. And here's the facts. Central banks have been intervening in markets since forever. So when we called the Euro-Swiss franc collapse, there were two, by the way, one in 2015 and one earlier in 2009. When it was 150 to the euro. The euro was this all-conquering currency, and that was post-subprime. Of course, we had rotten European banks that were in deep, deep trouble, etc. It was the precursor to the PIGS crisis. The central bank, you can see it in the price behavior, were already intervening and holding levels. Everybody thinks this is the first and only market that's ever had a statist major player be involved. The point is, you can hold back the tide. I can take an absolute ton of bulldozers and build a sand wall and try stop the ocean from coming on here just outside my window for a while. I can do all sorts of things to try dam up the Atlantic Ocean from washing in, but eventually you lose. What ends up happening is when you create a distortion in the market, it continues to distort and become ever more extreme until the participants no longer want to hold up the perverse hypervaluation end. And then it becomes everyone watching everybody else. Somebody's going to get shot in this room and nobody wants to stay. And everyone's looking at the door and waiting for somebody to twitch. And then they all turn and run at the same time because there's a shooter in the room. And that's kind of the situation you end up with. Who's going to hold up the lie once it's so obvious and so extreme and so costly to do and so damaging to do that everybody wants the reset, till eventually even those that were part and participants of something that were unsustainable change their mood music to, well, it's been known for a long time that we've had distortions and there's been too much debt. All these guys that are telling you today there's no issue with the debt, we can continue to operate, all will morph their message just before the ball is being dropped. So that you can manipulate, you can use leverage for a while, but somebody is going to build a massive deficit position of great quadrillions. millions, trillions, etc., a banking cartel. And eventually they're going to fold that as bankrupt, and they're going to try roll up all that debt. What happens is you never get true market discovery in the normal market, the control market, and then bang, they just have to reset it at something that reflects the normal price at some level. I don't think, personally, in my mind of game theorying this whole thing out, that you will get free markets take you to the true value of what gold should be and what silver should be for the amount of money that has been borrowed into existence. I think it starts to move in that direction. It starts to go into the elevator snapped cord, and they freeze frame and they go, okay, no more, it's broken. And they will use some sort of geopolitical event. Who'd have known China had hacked everybody's bank accounts, Iran had hacked everybody's bank accounts, something like that. Geopolitical event. Oh, we all lost our money, we got to start again, sorry guys, everything back to zero. And then you get a set value instituted by your oligarchy for gold and silver. You have to register as a gold and silver holder, and then the capital gains tax starts flowing, and all the other things that are typical of extractors and status systems. So I don't actually think we will ever trade through to full truth. I think we'll get to a point where you will potentially move in that direction.
As we navigate through the intricate narrative of silver's ascent, it's imperative to turn our lens towards a pivotal aspect that defines this precious metal: its price volatility and the realm of speculation that it engenders. Silver's price movements, characterized by their rapidity and breadth, contribute significantly to its allure, painting a picture of a market that is as dynamic as it is unpredictable. Silver, often overshadowed by the steadier glow of gold, has carved out its own niche in the world of precious metals, renowned not just for its industrial utility, but also for its potential as a speculative investment. Unlike gold, whose price movements tend to be more gradual and sustained, silver is known for its swift price fluctuations. This propensity for sharp movements can be attributed to a combination of factors, including its lower market liquidity and its higher industrial demand, making it more susceptible to market sentiment and industrial trends. This volatility, while a source of risk, is also what makes silver an intriguing option for speculative investors. The metal's price movements are not just numbers on a chart. They are reflections of a myriad of forces at play, from industrial demand and supply dynamics to investor sentiment and macroeconomic factors. It is this volatility that can lead to significant gains, as well as losses, making silver a metal that demands respect and careful consideration from investors. In this landscape of rapid fluctuations, speculative investing in silver becomes an art as much as a science. It's about understanding the nuances of the market, recognizing the patterns in the chaos, and making informed decisions amidst the whirlwind of price movements. For those who navigate this terrain wisely, silver offers the potential for substantial rewards. However, it's a path fraught with twists and turns, requiring a keen eye, a steady hand, and an unwavering resolve. As we continue to unravel the story of silver and its potential ascent to the remarkable price of $2,080, we must keep in mind that this journey is intertwined with the inherent volatility of its market. The speculative nature of silver investing adds an additional layer of complexity, making the path towards this ambitious price target a challenging yet potentially rewarding endeavor. In our upcoming exploration, we will delve into the impact of geopolitical uncertainty on silver and its prices, shedding light on how global events can shape the destiny of this versatile metal. Stay with us, and don't forget to subscribe to our channel as we dissect these complexities and continue to chart the course of silver in its quest to outshine gold and reach new heights. As we continue to chart the course of silver's potential ascent, it becomes increasingly important to consider the broader context in which this precious metal operates. Silver's price and appeal are not only influenced by market dynamics and industrial demand, but also significantly shaped by geopolitical uncertainty. This factor, often overlooked, is a crucial driver in the financial markets, weaving a complex web of influence that extends far into the realm of precious metals. In the last decade, the global stage has been rife with tensions and events that have sent shockwaves through the markets. From the simmering tensions between major world powers to the devastating impact of the COVID-19 pandemic, and from the geopolitical chess game of trade wars to the unpredictable nature of international conflicts like Russia's invasion of Ukraine, these events have created an atmosphere of uncertainty that investors find hard to navigate. In times of such uncertainty, precious metals like silver and gold have traditionally been seen as safe havens. They are the ports in the storm, assets that investors flock to in an attempt to shield their wealth from the volatility and unpredictability of other markets. As geopolitical tensions rise, so does the allure of silver, not just as an industrial commodity, but as a bastion of stability amidst the tumult. However, this relationship is nuanced. While geopolitical instability can lead to an increased demand for safe haven assets, the precise impact on silver prices is a dance of complexity. It's a ballet performed on the global stage, where each geopolitical development, each policy change, each economic sanction plays a role in shaping the narrative. Silver responds to these cues, sometimes with a steady climb, other times with sudden spikes or drops, reflecting the sentiment and speculations of a global investor community that is perpetually trying to read the tea leaves of international relations. As we edge closer to the apex of our exploration, it's crucial to recognize that the journey of silver to the monumental price of $2,080 is not just a story of supply and demand, industrial utility, or investment speculation. It's also a saga that unfolds against a backdrop of geopolitical drama, where each act and scene contributes to the shaping of silver's destiny. In our next chapter, we will delve deeper into the analysis by experts, peeling back the layers of the current market trends to uncover the insights and predictions that could herald the turning point for silver. Stay with us and remember to subscribe to our channel as we continue to navigate through the intricate mosaic of factors that pave the path for silver's potential rise to a price that could redefine its role in the precious metals market.
With your permission. So here's what's happened that's kind of super important and that everybody is a bit jaded about. And this is exactly how markets go up. You first show, and I'm actually going to pivot this just to the monthly to make the point, because it's on the monthly time frame that most people need to see that we actually had a seminal event. The blue line is the $2,000 event. It was a huge event also in the $1,000 when gold breached the 1,000. I've covered that many times, but I think we don't need to revisit that history. So this failed to close on the monthly above 2,000. This failed to close on the monthly above 2,000. These two shooting stars, those are, and that was also a shooting star over here, are exhaustive candles that traded through but couldn't hold. November was your first and foremost candle to ever close on a monthly time frame above 2,000. And I'm taking significance out of that many people are started to already feel jaded with, because the next candle went as high as 2,150 and got slammed all the way down, and they said, you jinxed it, etc., etc. This is how breakouts occur. You resist 3 times. You just run and then you resist. So this is part of HVF method, which we are known for in terms of understanding price behavior. The level gets run, but it's not held. 3 times you play with a line, 3 times you push back. That is the testing phase. Don't forget, in a bid and offer stack, you are thinning that offer stack out each time that happens. And more debt is being issued, more unsound money principles are being pursued, etc. Then you get the close. What happens is, okay, now you've broken, but you get the return move. We are quite possibly, even on gold, by the way, which has been shown a little bit more strength and spine than silver for now. And that's exactly how precious metal bull markets roll, guys. Gold is the driver. The engine is in the 4x4, not the trailer. It drives first, it leads, it steers. The tension must be taken up in the bungee cord. The trailer does lag until eventually so much built up inertia and potential energy is built up in the rubber cord that it then overperforms later. So in any bull market for precious metals, you need to be in gold first. People underrate it. They go, oh, silver's going to go up more. Let me go buy silver. And then they say, wow, it never happened the next day. It never happened the next week. It didn't happen the next month. That's unfair. It's never going to happen. No, people told me the bond market would never turn. We were supposed to get negative interest rates. People were selling 100-year Austrian debt with negative interest rates. 100-year. You want to give away your money and get guaranteed less back in a fiat proliferation thing. That is peak insanity, and now everyone's woken up. Those bonds must have lost I don't know how many percent. So we've had the awakening to the debt crisis. So the people bailing on silver now and with the impatience are actually leaving the nightclub just before you two walk in and start playing. Literally, the party's about to get started and they're going, damn, we waited too long. Who do these guys think they are? Storming off in a huff. The debt market collapse is the beginning of that turbo juice, and it drives first through gold, and it needs to be recognized by the central bankers, such as the likes of China, Russia, who are already doing this. So all the facts are here. The problem is people lack patience. They're seeing the dominoes falling slowly but surely, but they're giving up. Don't get into silver if you don't have the time frame for silver. You must match. This is a key learning point. You must match your time frame to the investment category. If you want it tomorrow, next week, next month, don't buy silver. Buy gold. Buy gold right now, or even buy something that's got inherent momentum right now before gold. Even gold is going to possibly have a small pullback here. It could return to the 2K and just run it to the downside and then rally. In fact, it's
We now shift our focus to a crucial element of our story, the insights and analyses provided by financial experts and market analysts. This collective wisdom, drawn from years of experience and deep understanding of market dynamics, offers a unique lens through which to view the sluggish yet intriguing current trends in silver prices. Across the globe, financial experts are closely monitoring the pulse of the silver market, analyzing every fluctuation, every trend, and every possible indicator that could signal a shift. Despite the current bearish sentiment, these experts are cautiously optimistic, recognizing that beneath the surface of immediate market trends lies a potential for dramatic turnaround. They understand that the journey of silver is not linear, but cyclical, filled with periods of lulls and sudden surges. One of the key points of focus for these experts is the underlying strength that silver possesses, often overshadowed by short-term market pressures. They point to the robust industrial demand, the growing interest in silver as a safe haven asset amidst geopolitical uncertainties, and that historical resilience silver has demonstrated in the face of economic upheavals. These factors, they argue, form the bedrock upon which silver's future ascent might be built. However, these experts also caution against a simplistic view of the market. They remind us that the world of precious metals is complex and interwoven with a myriad of global factors. The cautious stance of the Federal Reserve, the performance of the dollar, the state of the global economy, and the shifts in investor sentiment are all pieces of a larger puzzle. Understanding how these pieces fit together is key to unraveling the true potential of silver. In their analyses, these experts often highlight the potential energy that lies within the silver market, akin to a coiled spring waiting to release. They talk about the signs that could indicate a tipping point, the triggers that could unleash the latent power of silver, and the scenarios that could lead to a revaluation of silver's true worth in the global financial landscape. As we move forward in our exploration, it's essential to keep in mind that the insights of these experts are not mere speculations. They are informed predictions based on a thorough understanding of market dynamics. They remind us that the journey towards a possible $2,080 price for silver is fraught with uncertainties and complexities, but also filled with potential and promise. In our next step, we will explore the phenomenon of the silver squeeze movement, its impact on the market, and the broader implications it holds for the future of silver. Stay with us, and don't forget to subscribe to our channel as we continue to peel back the layers of this intriguing narrative, inching ever closer to the apex of silver's potential ascent.
So, again, a great question. Let's deal with the last part. Do I go for the miners yet? The answer is not actually yet. You have so much time, and the time frame for this is large. You have both, you mentioned Rick Rule, who's delighted that there's more time, he can stack up some more, and in some senses he's right. I don't feel right now the miners are going to, so the firing order, this is like you're sitting here and we've just popped the lid on my amazing Bugatti W16 engine. You know, there's so many variables in here and they have a firing order. You know, first it's cylinder 1, then it's cylinder 9, then it comes back and does 2 and then 10. And, you know, every cylinder will fire at some point. So we're watching it and we're trying to track in which order are these dominoes dropping. Gold, the bullion, first on central bank buying. You know what? Tick. We've already begun that phase, but it's not a one-day phase. It's a 3-year, 5-year phase. It's been happening for a while and will continue to happen. Next phase, the other metals start to stir, such as platinum, silver, the platinum group, which you've already had, rhodium, very rare, and palladium, multiple shoot. So don't forget, there's other little bit part players that have already started and partied and now are actually had a big bear market collapse actually in palladium, which we've called, and in rhodium, back from almost in the 30s down to falls. Now that was supporting platinum being sold under value in South African mines. Now that's not happening. So that's going to lead to a greater platinum price in time, but not yet because you're trading at cost. So the miners will follow, but they'll probably follow last. And in some cases, particularly the marginal miners that are barely turning a buck, they will follow at multitudes, but don't position too soon if you haven't got the patience of the timing. So everyone wants to buy for today. So just looking at the gold chart over here, it's not about to explode technically for me post this. I could see it drifting off and calming down and putting everyone back to sleep. That is the absolute sign of the setup. But putting everyone to sleep at a point where it's now actively got base camp above the 2K level. And people aren't seeing the significance of that. What was a resistance 3 times on a monthly close now becomes a substantial support. And this is progress, but it's not fast progress. And it's designed to dopamine you. You know, you're being put to sleep. The intravenous injection of morphine is going in there and you're being lulled away. It's very hard to recognize that incrementally you are watching a tortoise move here. And you're not even sure it's moving, but when you look away and you look back, you see it's not quite where it was. This is designed to catch you because that tortoise suddenly turns into a rabbit and it's off like a dirty sock. And then you've missed the game. So inherently you have to watch the slow phase, because it's designed to shake you out. Other things will be pumping. Crypto, Bitcoin, woohoo, go look somewhere else. There's no party here. You come for your New Year party and the band hasn't even plugged in their guitars yet. Everywhere else there's music going, you run away. Boom, you miss the main.
In our ongoing exploration of silver's dynamic journey, we now turn our attention to a recent and significant phenomenon that has left an indelible mark on the silver market: the silver squeeze movement. This movement isn't just a footnote in the annals of financial history. It represents a moment of awakening, a collective push by a community of investors who aim to challenge the status quo and unlock the true value of silver. The silver squeeze movement emerged as a powerful force, driven by a community of investors connected through social media platforms and forums. Their strategy was clear and bold. By collectively purchasing physical silver and silver-related financial instruments, they aimed to exert upward pressure on silver prices, thereby exposing and challenging the alleged market manipulations and the disparity between paper silver and physical silver holdings. This movement brought to the forefront the passionate debate about the transparency and integrity of the silver market. It highlighted the complex interplay between physical silver and paper contracts and sparked discussions about market liquidity, short positions, and the true representation of supply and demand in market prices. The impact of the silver squeeze movement was felt across the market. It led to a surge in demand for physical silver, with dealers reporting record sales and shortages of silver coins and bars. The movement also caused ripples in the prices of silver-related financial instruments, as more and more individuals joined the cause, eager to be part of this unprecedented push for change. But beyond the immediate market impact, the silver squeeze movement signifies a deeper sentiment among investors, a sentiment rooted in the desire for a more transparent, fair, and true-to-value market. It reflects a growing awareness and skepticism about the traditional mechanisms of the financial markets, and a call for a reassessment of how precious metals are traded and valued. As we reflect on the implications of the silver squeeze movement for our story, it becomes clear that this is more than just a market phenomenon. It's a statement about the power of collective action, the quest for market integrity, and the unyielding spirit of investors who believe in the potential of silver. In our next chapter, we will delve into the psychology of investing in precious metals, exploring the intricate dance between long-term value and short-term market trends. Stay with us and remember to subscribe to our channel as we continue to navigate through the unfolding saga of silver and its quest to redefine its place in the world of precious metals.
So, in terms of macro commodities, generally, so that's the broad category from energies to the money alternatives, which is the gold and silver market, and the soft markets, the softs, the agris. So I'll give you a general statement on macro commodities. These are in a very bullish state, generally, as a whole. Energies, I'm going to put a small mark around them and just make a key comment. Generally, energies do have a real correlation to economic activity. Note I said energy is not uranium. So oil will likely underperform gold. So we have a money and capital preservation crisis at the moment, hence why gold first, and then later silver, then all the mines, possibly gold miners in and around silver, maybe one or two before. They've already started. So money, true money, as in gold and capital preservation, is now a higher priority than yield. So we've had the search for yield 40 years. Now we don't want to talk about return on money. We want to just talk of returning money and making sure it gets returned. And that is the capital preservation. So I see gold being one of the better in the macro commodity crisis because of its money, and we're having a money and debt-based crisis. If we have a demand-destroying event, and March 2020 was such an example, energies generally, so I'm more thinking oil and other things than specifically uranium. I'm going to mention that why I think uranium is unique in the energies category in a moment. But energies generally will drop. So I'm preferring, we had a real rainmaker trade, being long gold, short oil. During the prior in 2019 macro trade into the events that turned out to be March 2020, which I won't say the name of, and that led to a huge year for us. We were short liners, cruise liners, pipelines, and the commodity oil itself, and long gold. So we had a commodity neutral. So generally, I think oil could in parts go down inside an inflationary environment where generally it's going to be going higher mostly, but on account of loss of freedom of movement, things similar to lockdowns potentially taking place for whatever narrative, climates, pandemic Mark 3, 4, 5, things like that, and loss of economic activity, which is part of impoverishing the masses and making billionaires ever wealthier. So we're having this polarization. Remember, inflation is policy. It's central bank policy. And inflation makes balance sheet, people that own things with cheap debt, which you don't get to borrow at cheap debt, credit card being the most expensive debt, but even if you take car finance or if you take business finance, you don't get cheap debt. They get cheap borrowing and they buy assets. So the billionaire class gets richer. The rest, the upper middle, to the lower middle, to the working classes, all get impoverished. So this is a game of polarization of pushing everything. Though the economy still relies on a consumer, and the mass consumer will not be oil strong in a demand destroying event. And we should expect that to come because it's going to be the subterfuge that hides the debt failure. So there's going to be another geopolitical narrative. I've given you the global hack. So I prefer gold over oil. However, uranium is the best, in my opinion, of the energy classes fundamentally, because there's a sudden redawning of the value of nuclear power relative to all the others for the green agenda. It got stuffed during Fujitsu. I said Fujitsu, I think I mean in Japan. Fukushima, sorry, we actually long the equity Fujitsu. I'm totally dyslexic. Fukushima, nuclear crisis, and then of course Germany cancelled nuclear plants, and you've had that uranium guys were sitting there, like silver guys are today, saying it's never coming, it's never coming. So uranium, if we look at the chart, it had a collapse as well to a final shakeout low, and this is often what happens just before you run. They want to kill and humiliate the bag holders that have been holding forever. Do not, if you have a sell-off in silver, panic out if it drops. You've got to hold. This is why I'm not leveraged. Part of your previous question that I didn't fully answer is how am I playing it? Investment only, generally. Only if I get a unique setup am I actually using any form of leverage. I'm investment only. Silver and gold. It just sits there. It's a hold. There's a little bit of cost to carry. Sometimes it's got nothing to do with banks, and some of it you keep privately. But there, you just sit it out. You've got to guts it out, and you mustn't be a forced seller. Note our uranium over here, and I'll just draw some lines on the chart here. Had a final capitulation also with this global macro demand destroying event, which I expect another one.
As we delve further into the tapestry of silver's potential ascent, we approach a nuanced and often underappreciated dimension of our journey: the psychology of investing in precious metals. This realm goes beyond the hard numbers and market analyses, touching upon the beliefs, emotions, and strategies that guide investors as they navigate the silver market. The investment landscape for precious metals like silver is a mosaic of contrasting strategies and time horizons. Some investors are drawn to the immediate thrills of short-term gains, riding the waves of volatility with a keen eye on market trends and news triggers. Others, however, take a different path. They see silver not just as a commodity, but as a long-term store of value, a hedge against inflation and economic uncertainty, and a legacy that transcends the ebb and flow of daily market fluctuations. This dichotomy between the short-term speculator and the long-term investor is at the heart of the silver market's dynamics. For the short-term speculator, silver's volatility is a playground of opportunities, with each dip and rise offering a chance to capitalize on rapid price movements. These investors are adept at navigating the market's twists and turns, often driven by technical analysis, market sentiment, and a readiness to adapt to the ever-changing landscape. On the other side of the spectrum are the long-term investors, for whom silver is part of a broader strategy of wealth preservation and diversification. These investors are often less swayed by short-term market gyrations, focusing instead on the intrinsic value of silver, its historical role as a monetary metal, and its potential as a safe haven in times of geopolitical and economic turmoil. They invest with a vision that extends beyond the immediate horizon, often embracing silver as a means to safeguard wealth for future generations. Yet, regardless of their approach, all investors in the silver market share a common thread: the recognition of silver's unique place in the financial and industrial world. They understand that silver's journey is marked by both its lustrous appeal and its practical utility, making it a multifaceted asset that holds a unique allure. As we inch closer to the apex of our narrative, it's crucial to acknowledge that the current market sentiment might be obscuring silver's true potential. The short-term bearish trends, influenced by macroeconomic factors and market dynamics, may be temporary shadows cast on silver's long-term journey. For those with the patience and foresight to look beyond the immediate horizon, silver presents a narrative of resilience, potential, and enduring value. In our next step, we will reach the apex of our exploration, synthesizing all the elements we discussed to unveil a comprehensive conclusion. Stay with us and remember to subscribe to our channel as we prepare to uncover the culmination of silver's quest to outperform gold and reach the monumental price of $2,080.
With a different theme to come. Flush out before it then did up, 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 up. And there you have three legs up, and you have two sideways legs. This was kind of a broadening structure that I'm highlighting. You had a falling wedge here, and then you've had your high. That's your first leg advance for uranium. Then we went into a sustained period. We were a little concerned for uranium. I haven't been perma bull. You know, we said, hold on, there might be a chance of a head and shoulders, left shoulder and a head here. And we were watching this. It said it needs to not break here. So we were watching the 2850. We're on Sprott uranium as a proxy for uranium, by the way. Out of you like it. But since then, it clearly shrugged off this level and has wound up, and I think it's looking pretty good. But we could, just with some softness in the market, see a little bit of a retrace and then maybe a bounce back up, and could end up with a rather nice setup. But it's not I wouldn't say right now energies are going to be a major runner, but I think, again, you could go higher in due course because you're very close to previous highs. And I will highlight, the last time you were at these highs, you were in a blow-off state. This was really strong momentum. So you were kind of like an absolute surge that came out of that falling wedge interaction. This has been quite low volatility. It's squeezing higher, and it's very close to that legacy high. Could just have a little drift down a little bit, I would guess, to break into the new high. And then that could set up something that could be a nice squeeze setup. So it's a watch for me. If you get a bit of triangulation like that, it's a watch for me for future trade. I wouldn't jump in that close to the highs. I think it could ease a bit and you could get back in. But broadly, uranium positive about its future progress. And I see it as the star in the energies category. So I hope that's clarified everything. I would be investment only, and I would wait. I would have some limit orders down here. One of the things you can do which is very powerful technically, and we teach this in our program, is you can see where the bulk of the volume is taking place. And for that, you have what's called volume by price. You see that blue line at 28.50. I'm going to draw where's the volume taking place over that area since we jumped on the ledge. And you can see the bulk of it's been kind of lower third. You've tapped on the top a while. It's rare that after just a small amount, 70% is the dark blue. So you're not looking at the floor very much. That's good news. You're holding the low end of the 70% range is our 28.50, but you're about a third the way up. So a lot of the volume has been around here. So it's kind of consolidating. What you tend to get later is that you'll start to have more tapping on the ceiling. So you'll pull back a little bit and you'll start stacking these bars a little bit higher, and then you'll pause for a while, you'll have another attempt. Remember, 3 attempts, and then on the 4th you break. Much like I said on the gold, you're at probably number 2 now for that new high on balance of props. So a little bit of a squeeze here that I would suggest might see you come off a tiny bit, but not scary bad, but a little bit of a squeeze. But then again, not tomorrow, not next week, not next month, but in due course, I would expect higher uranium prices after a consolidation, a more sustained consolidation here. A lot of it's going to be on economic weakness on the consumer, but uranium is a bit more insulated than that, than oil for cars.
As we reach the apex of our journey, we stand at the precipice of understanding, poised to synthesize the myriad facets of silver's enigmatic dance through the financial and industrial realms. It's here, at this pinnacle of exploration, that we aim to weave together the threads of economic trends, market psychology, geopolitical uncertainties, and industrial demands to construct a comprehensive narrative. A narrative that not only explains the potential ascent of silver to an extraordinary $2,080, but also encapsulates the complex interplay of forces that could make such an unlikely scenario plausible. Silver's journey is not just a tale of numbers and charts. It's a saga written in the ledgers of global economies, etched in the fabric of industrial advancements, and narrated in the collective consciousness of investors worldwide. As we traverse through the landscape of this precious metal, we've uncovered a story of resilience, a story of potential waiting in the wings, ready to unfold under the right concatenation of global events and market dynamics. The cautious stance of the Federal Reserve, the fluctuations of the dollar, the shifts in industrial demand, the speculative fervor of the markets, and the looming shadow of geopolitical tensions. These aren't isolated chapters, but interconnected segments of a larger narrative. A narrative that suggests that while silver's current price may be subdued, the stage is set for a dramatic reversal, one that hinges on the delicate balance of supply and demand, investor sentiment, and global economic health. In the realm of precious metals, silver has often been overshadowed by the lustrous allure of gold. However, as we stand at the cusp of potential economic shifts and industrial revolutions, silver's role cannot be understated. It's not just a commodity, it's a harbinger of change, a barometer of economic health, and a beacon of potential in times of uncertainty. As we conclude this exploration, it's crucial to remember that while the ascent of silver to $2,080 is a scenario brimming with potential, it's also laden with uncertainties. The path to such a price is fraught with challenges and requires a confluence of favorable conditions: a weakening dollar, a resurgence in industrial demand, sustained investment interest, and perhaps most critically, a paradigm shift in the global economic narrative. And so, as we draw the curtains on this saga, let us not forget that the story of silver is far from over. It's a story that continues to evolve, shaped by the forces of market dynamics, global events, and the undying spirit of those who believe in the untapped potential of this enigmatic metal. Remember, the content shared here is not financial or investment advice, but a journey through the fascinating world of silver and its potential to redefine the precious metals market. Thank you for joining us on this exploration, and don't forget to subscribe to my channel for more insights into the captivating world of commodities and investments.